听见资本本期视频为您带来的是大摩根士丹利在4月2日录制的内容，主题为对决美国与欧洲股市。最近欧洲股市是不是让你觉得比美国那边强多了？但这股势头还能持续吗？或者说美国市场马上就要迎来一波战术性反弹了？这期节目里你会听到一场关于美股和欧股前景的精彩对决。来自摩根士丹利的美国首席策略师认为，近期驱动欧洲跑赢美国的一些因素正在发生变化，比如政策风向、关键投资的增长速度以及美元走势。他警告说，这可能意味着短期内资金会重新流向美国，之前强势的美国大盘成长股可能面临调整压力。但他也指出，从更长远来看，世界格局正在经历深刻转变，全球投资者可能因为分散风险的需求以及潜在的货币格局变化，不得不将资金从高度集中的美国市场分散到其他地区，比如欧洲或新兴市场。这对你的长期资产配置意味着什么？而欧洲首席策略师则提醒，虽然欧洲的结构性机会，比如财政刺激和自身投资增加，让他长期看好，但短期内要保持警惕。美元近期的走强对欧洲公司的盈利是个坏消息，而且市场对某些利好消息的反应可能已经有点过头了。他认为欧洲要想真正实现结构性的突破，可能还需要更多时间和催化剂。所以现在是继续看好欧洲，还是警惕美国市场的短期反扑？未来几年全球资本流动的方向会怎样改变？这场讨论充满了对当前市场热点的深度分析和潜在风险提示，直接关系到你的投资组合在全球变局下的布局策略。接下来是英文的全部内容，如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Welcome to Thoughts on the Market. I'm Paul Walsh, Morgan Stanley's Head of European Research Product, and I'm joined by my colleagues Mike Wilson, Morgan Stanley's CIO and Chief US Equity Strategist, and Marina Zavalok, our Chief European Equity Strategist. Investors are asking if Europe can sustain its recent stock market outperformance against the US, or if we're poised for a tactical reversal. And today's episode is going to be a special kind of face-off, looking at the relative merits of our US equity strategy views against our European stock market views as well. It's Wednesday, April the 2nd at 9:30 a.m. in London. Our clients love the face-off work that we do, and I think today we've really got the ultimate face-off, looking at the relative merits of our US equity strategy views and our European stock market views as well. So when I think about year to date, Mike, so I'm going to start with you. Europe's obviously done pretty well. I mean, we've seen clearly defense and banks being the main thrust of that performance relative to the US. And when we look at US equities, and I think this has been very consistent, honestly, with the views that you've been expressing since the start of the year, there's been weakness there, driven by a range of factors that I think everybody listening in will understand and are well documented. But the key from my side is, I sense you think there may be a tactical opportunity here, and that we could be on the cusp of seeing something of a rotation back into US equities. So I wanted to hear your views, how they're evolving, and if you think there's a real tactical opportunity here.
I've not really been surprised at how the U.S. equity market has traded this year, given our view in the sequencing of policy. I think the surprise for me, anyways, is just how much Europe has gone up. And I think a lot of that just has to do with flows and flows of capital. So, I mean, to me, the question for whether this is going to be, kind of a structural change is like, what's really driving the outperformance in the near term? Is this something that is, temporary, or is it something that's more secular and structural? And I think it's probably both. And the reality is that it probably overshot a bit in the initial move here. And I want to just back up and kind of talk about the U.S. has been the biggest outperformer for a decade, and it's been driven by, kind of a handful of stocks, or, the large cap growth segment. And I think it's interesting to just point out that that's a global phenomena, right? Meaning the high quality growth stocks in Europe have also done really, really well. It's just there's not as many of them. And similarly in Asia, the real story here is just that, large cap quality growth and even somewhat defensive have just carried the day kind of post 2021, but really over the last 10 years. And the question is why? Well, because, organic growth has really not been that good. It's been very subsidized by government spending, other policy measures. And, it's this crowding out feature that we've written about extensively. And that crowding out has led investors to essentially shun bonds and buy high quality stocks. So now, at the end of last year, we had a couple of headwinds to this theme from a U.S. perspective. First off, the Fed stopped cutting interest rates in December. Number two, the fiscal impulse is reversing because it was unsustainable. The other one that doesn't get a lot of airtime, but some people have been talking about, including us, is just the peak rate of change in AI CapEx really occurred in the fourth quarter, and now it's decelerating. Doesn't mean we're going to have negative growth. It just means deceleration. But, growth stocks key off of that. And that has driven revision breadth to be quite negative in the U.S. for the first time, really in several years, and also on a relative basis. So I would argue that a relative performance of Europe over the U.S. is really related directly to that relative earnings revision breadth, where Europe has been better relative to the U.S. And then I think the bigger question is what happens after that? So we think there's, another 3, 4, 5% of relative value here for U.S. S&P 500 over, say, Euro stocks in U.S. dollar terms. And then I guess I'd lastly just point out that the dollar itself was a big part of this move, the dollar-euro exchange rate, which was very strong at the end of last year. And that was a headwind for earnings growth in U.S. companies and a tailwind for European companies. That now is reversed as the dollar has weakened substantially against the euro. So I think, Marina will talk about this as well. We believe that the relative earnings revision breadth between U.S. and Europe could reverse in Q1, really just on that currency exchange rate getting weaker now towards the dollar and stronger for the euro.
Second question for you, Mike, before we move on to Marina to understand the sort of tactical view around Europe. You talked about, the bigger question is what happens after that, and you're referring to this sort of relative pickup in the US versus Europe. So I wanted to cast our eyes a little bit further out. How are you thinking about the outlook for the US equity space as we kind of cast our gaze towards the end of this year and moving into 2026?
Well, I think that there's two ways to think about this. First of all, it's the index itself, or the S&P 500, the highest quality index in the world, versus, say, the average stock. Okay. And, a lot of things that have helped the S&P 500 that are unique, lower tax rates in the U.S. Think about the operational efficiency of which companies have, operated in the U.S. They're a little bit more, I think, shareholder focused. And so the question is, could there be a reversal in some of those relative trends? And I think the answer is yes, meaning Europe could lower taxes. They could lower regulation. They could create incentives for businesses to operate more freely. And, those two on a relative basis, even if the U.S. just keeps doing what they've been doing, the relative opportunity set looks a little bit larger. So I think there's an opportunity for two things to happen. The average company could do better than, say, the index once we have this transition, which is going to take another probably 6 or 12 months. And then secondarily, we could see a diversification of ownership away from the U.S. back towards other countries, not just Europe, by the way. That could be Asia, that could be emerging markets. And I think the key there is going to be what happens to the U.S. dollar. So even if you don't believe this story, a global investor needs to be rotating back. They need to have better diversification in their portfolio because it is going to be an uncertain world for probably a period of time as we go through a major transition here, this multipolar world that is continuing to evolve, maybe back to a mercantilist type environment, something we haven't seen in 30 years. And then the currency, there could be some sort of a currency accord, which would force the redistribution of assets away from the U.S. to other parts of the world.
Mike, thanks for that. How are you thinking, Marina, about the tactical situation here for European equities after this strong run that we've seen so far this year?
The key question that we're getting is about earnings. So as we head into the 1Q earnings season, a lot of investors are asking, will Europe have this kind of outperformance in earnings that we saw last quarter? So just to remind, last quarter, European earnings revisions breadth really outperformed the U.S. They basically diverged in opposite directions. Going into this earnings season, you literally have the opposite dynamic. So you have the dollar that's depreciated by about 5%. That's not going to flatter European earnings versus the U.S. The last thing I'll mention here is that on this kind of higher spending and excitement on Germany, we really like Germany structurally. We think that this increased fiscal spending is a game changer. But we've also done a lot of analysis comparing to the Infrastructure Investment and Jobs Act in the U.S. and basically have found that what you tend to have at this point of the recent rally that you had in exposed stocks to, for example, the infrastructure fund is a travel and arrive situation. And pretty much the next positive catalyst we expect in Germany are going to be with the release of the budget when we get more details on how the money will be spent. And that's not until May or June.
Okay, thanks for that, Marina. So you've laid out, I think, very clearly the tactical view on Europe. How should we also be thinking about the medium-term sort of structural dynamics for European equities in that sort of relative global context?
One thing we like to track really closely is the like-for-like discount of Europe versus the US. And the reason we track it closely is because this discount travels within a pretty stable downwards range. So over the last 10 years or so, we've seen European discounts versus the US widening structurally, and they've been doing that within a range. And the question for me, which I think you're asking, is, are we going to break out of this range? I don't think we're going to break out at this very moment, but I think it is possible that we break out possibly in the second half of this year. I think there are a lot of important dynamics and, changes, let's say, happening in Europe. I think that's really important because part of the reason Europe's outperformed is because investors are worried about the level of concentration of the US in their indices. So if you have this kind of dynamic of repatriation back to Europe, and you have this continued diversification theme later this year, I think after we pass this earnings season, that could propel Europe to maybe structurally break out versus the US rather than just have a tactical rally. So this kind of renewed self-reliance of Europe investing in Europeans' future, it can become a very bullish story. So I don't think this kind of tactical pullback we're seeing right now is the end of the story.
Mike, Marina, thank you both very much for taking the time to talk. And to our listeners out there, as always, thank you for taking the time to tune in. If you enjoy Thoughts on the Market, please do leave us a review wherever you listen, and be sure to share the podcast with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.